The AI loan market just saw a surge in investor demands, with borrowers offering better terms. This news has many investors experiencing FOMO, or the fear of missing out. According to a study by Kaplan and Heinlein, 69% of millennials experience FOMO, leading to impulsive financial decisions. FOMO is a common phenomenon in financial markets, where investors feel pressure to invest in a particular asset or market, fearing they'll miss out on potential gains. This fear is often driven by social media and news outlets, which can create a sense of urgency and anxiety. Research by Kahneman and Tversky found that people feel losses 2x more intensely than gains. Imagine you're at the supermarket, and you see a sign that says limited time offer, buy one get one free. This creates a sense of FOMO, making you feel like you need to buy the product now, or you'll miss out on the deal. This is similar to how investors feel when they see a hot stock or market trend. A study by the Harvard Business Review found that limited time offers can increase sales by up to 25%. However, FOMO can also lead to poor investment decisions, such as investing in a stock or market without doing proper research. According to a study by the Securities and Exchange Commission, 60% of investors don't do their own research before investing. This can lead to significant losses and financial regret. So, how can you avoid falling victim to FOMO? One strategy is to take a step back and assess your investment goals and risk tolerance. Ask yourself, is this investment aligned with my long-term goals, or am I just trying to keep up with the crowd? Research by the CFA Institute found that investors who take a long-term approach tend to outperform those who try to time the market. Another strategy is to diversify your portfolio, spreading your investments across different asset classes and industries. This can help reduce your exposure to any one particular market or stock, and minimize the impact of FOMO. A study by the Journal of Financial Economics found that diversification can reduce portfolio risk by up to 30%. But what about when the market is trending upwards, and it seems like everyone is making money? How do you avoid FOMO in a bull market? According to a study by the Federal Reserve, 75% of investors tend to chase returns, investing in assets that have already gone up in value. However, this can lead to a phenomenon known as FOMO-induced overvaluation. FOMO can also be driven by emotions such as greed and fear. When investors see others making money, they may feel envious or left out, leading them to make impulsive investment decisions. Research by the Journal of Behavioral Finance found that emotions play a significant role in investment decisions, with 80% of investors reporting that emotions influence their investment choices. So, how can you overcome FOMO and make more rational investment decisions? One strategy is to set clear investment goals and stick to them, rather than chasing returns or trying to keep up with the crowd. According to a study by the Financial Planning Association, investors who have a clear plan tend to outperform those who don't. Another strategy is to educate yourself about investing and personal finance. The more you know, the less likely you are to fall victim to FOMO. According to a study by the National Endowment for Financial Education, investors who are more financially literate tend to make better investment decisions. But what about when you're already invested in a particular asset or market, and you start to feel FOMO about potential losses? How do you avoid making impulsive decisions based on fear? According to a study by the Journal of Financial Economics, investors who take a long-term approach tend to be less affected by short-term market fluctuations. FOMO can also be driven by social pressure, with investors feeling like they need to keep up with their peers or friends. According to a study by the Harvard Business Review, social influence can play a significant role in investment decisions, with 60% of investors reporting that they are influenced by the opinions of others. So, how can you avoid falling victim to social pressure and FOMO? One strategy is to focus on your own investment goals and objectives, rather than comparing yourself to others. According to a study by the CFA Institute, investors who focus on their own goals tend to be more successful in the long run. Another strategy is to find a supportive community of investors who share your values and goals. This can help you stay focused and motivated, and avoid the negative influence of social pressure. According to a study by the Financial Planning Association, investors who have a supportive community tend to be more successful and confident. But what about when the market is experiencing high volatility, and you're not sure what to do? How do you avoid making impulsive decisions based on FOMO? According to a study by the Journal of Financial Economics, investors who have a clear investment strategy tend to be less affected by market volatility. FOMO can also be driven by a fear of regret, with investors worrying that they'll miss out on potential gains if they don't invest in a particular asset or market. According to a study by the Harvard Business Review, the fear of regret can play a significant role in investment decisions, with 80% of investors reporting that they worry about regret. So, how can you overcome the fear of regret and make more rational investment decisions? One strategy is to focus on the present moment, rather than worrying about potential future outcomes. According to a study by the Journal of Financial Economics, investors who focus on the present tend to be less affected by the fear of regret. Another strategy is to practice mindfulness and meditation, which can help you stay calm and focused in the face of uncertainty. According to a study by the Financial Planning Association, investors who practice mindfulness tend to be more successful and confident. But what about when you've already fallen victim to FOMO, and you're not sure how to get back on track? How do you recover from impulsive investment decisions? According to a study by the Journal of Financial Economics, investors who take a step back and reassess their investment strategy tend to be more successful in the long run. So, what can you do today to overcome FOMO and make more rational investment decisions? Take a step back, assess your investment goals and strategy, and focus on the present moment. Remember, investing is a long-term game, and it's okay to take your time and make informed decisions. Start by taking one small step today, such as reviewing your investment portfolio or seeking the advice of a financial advisor.